Good Friday afternoon, Mark Chameleon and everyone joining us for the first time. Thanks for coming by and checking out the midday afternoon show with the main man, all the way from somewhere sunny and bright, Dimitri Pargamonik. How you doing, D?
Good morning or good afternoon,
Afternoon,
actually.
yes.
Afternoon. Well, good afternoon.
I apologize to everyone. I wasn't able to do the morning show, but we figured we'd get the afternoon uh, a
Try.
shot. See if anyone comes, how it works out. But do you want to start with the disclaimer?
Yep. So, can you put that disclaimer up, Will?
Oh, sorry, D. I thought I
Yep.
was sharing it.
And uh, so while Will's putting it up, before we get started, keep in mind Will and I and Market Chameleon. There it is. We are not a registered investment advisor. We are not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Yep. And I am going to share my screen. And while I'm sharing my screen, anybody joining us for the first time, Will and I, we do these shows usually in the morning to help answer questions you may have about the Market Chameleon tools, the data or analytics. If you want to come on the show and ask your question live, we do provide a link to Zoom on that live chat on YouTube. So if you click on that, it takes you over to Zoom. Once you're in there, click on raise your hand. You could ask your question live. If you prefer to type your question in, you could type it into the live chat. Will's watching it and he'll read those questions back to me. And while we're waiting for questions to come in, maybe some more people to join us. The kind of like first time we changed the schedule from early morning to afternoon. What we can do is maybe start going over some things that are currently happening in the market. We'll see if we could get some insights from that. Usually we start out with the pre-market report, but now it's already, we're way into the trading, regular trading hours, 1 p.m. So what I'll do, Will, is from the homepage, we have these alerts that are coming in, and they're updating, and I'm going to pick one in SPY over here, the bullish calendar spread. Okay.
Right.
So what I did was you can isolate them from here. So here's a bullish calendar spread opportunity. And I'm just going to do the SPY one, which is the S&P 500 ETF. And it created this alert, which said, as we're scanning markets and making analysis on different markets and prices, and looking at the prices versus theoretical values, this one popped in and said there's a bullish calendar spread, which theoretically looks cheap or like a good price, right? So if you click on it, it takes you over to here and tells you, well, this is the spread. Selling September 15th, 472 strike, buying the September 29th, 472 strike. So you could see it's the same strike, different expirations, right? Calendar spread. One is 34 days away. One is 44 days away. It's bullish because we're looking at a strike that is above the current price of SPY. So if I come down here, here's SPY 457. Well, the sweet spot is that SPY goes right to 472 and stays there until this first one expires, September 15th, because at that point, the September 15th option then will expire worthless if it's exactly at the strike or right below it, and then the next strike out will be at the money, which is the most time premium, is when it's at the money, right? So So the 472 strike is basically the target price in this spread. It did pick it out also where we get this indication here. So you see this little green guy, that's an indicator that it's in an uptrend. Basically, if we take a look at the moving averages and compare all the moving averages versus each other, the stock or this SPY ETF is in a technical uptrend. Okay, that's what these are. If it hits a 52-week high, I think you'll get a different indicator like this, so let's stick with this SPY, and here are a little bit more details here. It says that, if you buy this on the offer, the spread, it's 88 cents. Historically, if we took SPY in a similar situation and we looked at our data, how these two similar expirations with similar strikes away from the spot price, if we looked at our historical data, we said on average, this spread was 144. So there were times it was below 144, times above 144, but on average, the way that these options lined up, the average value of the spread was $1.44 based on historical data. What does that imply? That the current price is 39% below that average, right? So if we took the average as our fair value over the long period of time, then this is at a 39% discount. What does it mean? We don't know if it goes back to the average, if we'll go back above the average or stay below. What we do know is that if we use those metrics, currently it's 39% below that average. And if we took a scenario where the stock hit our target price of 472, okay, if it does go to 472 September 15th, and the options revert to their median implied volatility, then this spread has a profit potential of 528%. So the idea is, okay, we're getting it at a discount to historicals. It's a bullish spread. So if we think that SPY is going to continue to be on a bullish trend, this lines up with that outlook. And if implied vols then revert back to their historical median, we have a 500% potential return. Yeah, so it pays 5 to 1, right? If potentially. So if we click on this, it opens. Hold on a second. If I click on this, right, it'll say view this in the options chain. So right now, it loaded up the options chain, and it's showing us here's the September 15th 472 call at 2:59. And this is the September 29th 472 call, 346. All right, that's the current price. So these prices could have changed from the time this alert, right? Because the market prices are continuously moving. So even if you take a snap time, you still have to check where the market's moving to. So if we calculate that, right, so we see it's 87 cents right now. So you could see the current market, 82 cents bid, 87 cents, the midpoint's 85, right? So let's just use this 87 cents for now to do the evaluation. Hopefully you guys are good traders and are able to get better executions than that, but let's stick with that for this analysis. So let's take a look, before this payout diagram, let's take a look at this IB theorem. How do we get this? Right now it thinks that this strategy, the average is $1.43. So how do we come up with that? Well, if we use this model, right? Our question is, well, what do we think the average of this value of the value of the spread is? That's our question. So let's take 4 years of data. I'm going to keep it on there. These are the default settings. We could change it, but let's stick with that. This model is also using a dynamic IV range, which is saying that it's going to narrow down the data to the historical implied volatilities that were the closest to where we are today. So it'll throw out 1/3 of the data above, 1/3 of the data below to narrow down where the implied vols are more closely in line with today's implied vols. Okay, so if we're at the top end, it will take out all the bottom end. If we're in the low end, it'll take out all the upper ones. If we're right in the middle, it'll take out those to narrow down this data. But you can change it and just say, show me all, or do a custom. But let's use this for now. And SPY doesn't have any earnings, so these will not really matter, these settings. And when it runs it, it says, okay, retrieve data, look for the first option 1, 34 trading days to go, with an option 3.2% above spot price. And then next, look for options that have 44 trading days to go, also with the spot price 3.2% above. Forget the earnings, right? And it goes back and it retrieves these snapshots back in time where they're, at the same time. Where were these, synchronized at the same time? And it looks for the implied vols, right? So you could see there's a spread between the implied volatilities between these two options that are in different expirations. So there's somewhat of a horizontal skew there. It goes back in time, right? And it says, okay, if we use these implied vols, right, what would the value of each option be? And given the value of each option, what would the value of the spread be? So it's continued, and it just keeps going back and doing it, right? Goes back in time and keeps doing that. And then it says, okay, now I see the data here, right? I could sort it, whatever, look at the data. Give me the summary of this data. So here we see that the average value is $1.43, the high 263, low 85. So we see we're like already on that low end. Okay. I can take this off, but then it show all results, run it. And then if we do all the results, you see how the data changed. Now the average value changed. The low seems the same. The high went up. But let's go back to the dynamic, just to compare that again. So you see how that came in, and you could change the number of years. If you just want to narrow down to the last year, because maybe that's more relevant than the previous years, take out some of the effects of COVID or interest rates, whatever, take that out. Testing it from here, we see that using the historical data, today we're below that, and the low for the last year, and this is the range 208.89 with an average value of $1.43. So we could see that the implied volatility, the pressure's coming in, the Vegas are coming in, right? And that's why this time spread is getting cheaper, because vols are coming in, and as vols come in, we know that the vols on the longer end of the longer dated options are much more sensitive to Vega, right? So it's getting cheaper, and right now we're on the low end, right? So the idea there is, if the market continues to move higher and implied vols start kind of ticking back up, then this spread would benefit from it. And as you could see here, at this point, there is a pretty significant discount to the average. So that's what this alert was trying to point to. So you could kind of go to it and analyze it further, especially if this strategy, you remember this strategy has to line up with your outlook or your portfolio positions and risks. If this adds to, value to your overall portfolio in a way that it either reduces risks or puts in inventory that diversifies your risks, or, then that's a candidate for your analysis. Okay. If we don't have questions, I'm going to take another one.
Yeah, let's take another.
All right, so let's take another one. I'm going to come through here, just pick some out that, are more of analyzing trades than just like alerts of something going on unusual. So let's do we're in earnings season. So let's do this one. So pre-earnings straddle opportunity. So here's one in CPNG. And this is telling us pre-earnings straddle opportunities, 8 days to go. Okay. And explains it here, announces, that on Tuesday, August 8th, okay, this is gonna report earnings after the market closed. So this stock, CPNG, is scheduled to report earnings August 8th. So right now we're looking, so what it's doing is saying, well, where is the current straddle that covers this expiration, right? And the current straddle is pricing in a move of 9.5% from now to its expiration. So if we go down here, right, we see here's August 11th. August 11th, there's going to be an earnings. Okay. I'm sorry, August 8th, there's an earnings. So August 11th will cover that earnings because these options expire after earnings, after August 8th. So it's looking at August 11th and it's saying, okay, where's the stock, right here. It's looking at the straddle, right? Buying and selling, it's interpolating what the straddle will be in between. But let's just use this one as an example. Okay. And saying, okay, oh, here it is. So here, buying the August 11th call, buying the August 11th put on the 18th strike. And it's looking at the straddle and saying, okay, the cost of it is about $1.72, right? And where's hold on a second, where's that? CPNG, right? $1.72. If we go down here, hold on a second, does this cover? Oh, that covered up. So let me just keep it on there. So 1776, it's about, a 9.5% move that's required for the CPNG to break even. Okay. It moved 4.6% just today, but the straddle has, look, 10 trading days, right? So this straddle, so why did it pick it out? Well, the straddle has 10 trading days to go. And this is looking at a pre-earnings straddle and saying, well, what is typically in this stock, CPNG, what is typically the straddle price on average right before earnings, right? So right before earnings, which will be August 8th, right before earnings, the straddle's priced at 10.5%. That's 1% difference, right? So this straddle, right, if it gets to the average from now to August 11th, just to the average, we have a 1% discount at this point. right? Even if the stock doesn't move, nothing, if it gets back to the average premium, there's a 1%, there's a 1% difference, right? So this is a 1% difference in the implied move, right? So the straddle would have to whatever increase maybe by 10% or something, but the 1% difference in the implied move. Okay. So if there's a 1% difference, we're getting at a discount. Well, that seems pretty good. But what else do we get? Anybody can figure it out? What else? What value do you actually get besides this potential 1%? If you're thinking of it as a trader, what are you getting right now that could be very valuable between now and August 8th? Okay, so August 8th, we already established we got some days to go there, right? We're Friday, but we got next week, Monday, Tuesday, Wednesday, Thursday, Friday, another Monday. So what are we getting for this strategy? A potential move. You guys see that? Hopefully.
I did.
Huh?
I did.
If
It's
not,
awesome.
no. Well, you guessed it, right? Because what are you getting for that straddle? Like, think about it. Not only does it have the potential to appreciate in price with absolutely nothing happening, but you have the almost for free a potential move that could make this straddle in the money even before we get to that earnings.
Oh, that's awesome.
Huh?
That's awesome.
Hopefully you guys see that, because if
Yeah.
that's going to be a really big problem. Huh?
Yeah.
You'd be spotting that right away. So, all right, guys. Well, I showed you guys 2 alerts today. We did one in SPY. We looked at a calendar spread alert. The analysis showed us that, hey, if you're bullish, that you think that we're going to continue to rally higher, and you think that volatility is low and it's more likely to start heading back to its mean, or median, then there's an opportunity in this calendar spread. Then we went to another alert and said, look, if you're trading earnings, you're a volatility trader, and you're looking for a potential straddle, well, here's a situation where, the straddle is priced below with whatever, more than a week to go. It's already priced below where it's typically priced the day before earnings. And on top of that, you have a potential move between now, because anything could happen, right? We don't know. Like, nobody knows for sure. There's not going to be news between now and earnings.
Not only is individual stock news could happen, but news could happen in the marketplace, right?
In the marketplace, whatever. You're right. There could always be something that happens that could make a stock move. I'm not saying it will, and maybe the straddle will be a loser. The straddle could be 8%, before. The idea behind it is that, there's a certain situation that's setting up that looks kind of interesting, and, can you go and analyze this further? And maybe there's a reason, I don't know what, that it should be lower, but the alert is kind of pointing certain things out. Okay.
Well, that was awesome, D.
Right.
Using that, we do so few shows when the market is open. That was very insightful and interesting. The Chameleons enjoyed it. It was some great information. Thanks so much, my friend.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day. Hope
great weekend.
Have a great weekend.
Yeah.
Hope to see you guys on Monday.
All right. Great job, D. We'll see you on Monday. Have a great end of the trading day, everyone.